Minister last Friday unveiled the budget for 2013. What should investors do? This morning, BFM's Koo Sian Chun speaks with David Ng, CIO of Huang Investment Management, to get his take.
So, David, what points do you like about the budget?
Hi, morning, Chun. I think overall, from our perspective as fund managers, we think that the budget is a non-event to the market. From our standpoint, it was pretty much what was expected because the government had to tread carefully between being fiscally prudent as well as the fact that it's the last budget before elections. In terms of the things that we like about the budget, I think the first thing that comes to mind is the initiative taken by the government to develop the higher value-add oil and gas industry. So in line with that, the 10-year tax exemption for refineries we think is a step in the right direction. Malaysia, as we know, is a country that's blessed with oil and gas, so trying to develop the downstream side of the oil and gas industry is something that should be lauded. Secondly, I think, again related to the oil and gas industry, is the tax exemption for Lng Trading. As pointed out in the budget itself, LNG is going to be increasingly relied upon as a fuel source. Therefore, giving Malaysia that kickstart to develop LNG trading, to develop Malaysia as a hub, again, is a positive in our view. Apart from those two oil and gas related industry initiatives, from our perspective, the decision not to raise too significantly the RPGT is a positive as well, because I think since end 2010, when the loan-to-value ratio had been reduced to 70% for the third property, I think we've already seen that the property sector in Malaysia, we've seen more gradual price rises, and slapping 30% RPGT, which was rumored to be the case, I think would have dealt too severe a blow to the property sector. Apart from that, in terms of various industries or sectors that received a positive boost from the budget, I think one of them is the tourism industry. In line with next year in 2014 being Visit Malaysia year, the allocation, while not a lot in development expenditure terms, but the exemption for tour operators, I think that would encourage them to step up their marketing efforts to bring in more tourists to Malaysia. So sectors or industries, companies that are involved in tourism, the hotels, malls, retailers, airports, airlines, these are sorts of companies that could benefit.
Which areas do you feel were not adequately addressed, though, on the downside?
The areas that were not adequately addressed, I think, are areas or segments that have been talked about a lot already. I think the first thing that comes to mind, obviously, is a narrow tax base for Malaysia. I think a lot of panelists and a lot of commentators have spoken about it. I think it's an issue that becomes more pressing over time. Currently, our finances is still sufficiently strong, but I think all parties are aware that our public debt to GDP ratio is approaching the 55% mark. We are aware that only 1 in 6 people in Malaysia pays income tax, and we're also aware that the proportion of our workforce that have university qualifications is also not significant. Therefore, their ability to obtain higher paying jobs and therefore pay taxes is limited. So that's something that I think should be addressed more clearly, maybe not, if not already in this budget, then subsequent budgets where a timeline has to be set and stuck to.
Yes, and we can identify with the unhappiness about narrow tax base. And moving on to agro-sukuk, with access to bonds being open to retail investors, how do you think retail investors could reconsider their asset class mix?
On agro-sukuk, I'm not familiar enough with it because I think the SC still has to come up with its guidelines. But on the surface, it is a positive because it will facilitate fundraising, capital raising for companies involved in agriculture. But in my opinion, in and of itself, it's not going to boost the agricultural sector. It will facilitate fundraising, as I mentioned, but whether a company chooses to invest, chooses to expand land bank, or set up a mill would very much be dependent on the economics of the industry or the commodity. Yeah. As for your second question about retail bonds, again, it is positive. It allows retailers to participate in a new asset class, whereas previously for retailers, it's really stocks or unit trusts or deposits, and we find that there's plenty of deposits in the system. A lot of retailers or individuals are risk-averse. Now they've got another option, and that's by investing in retail bonds. And from the government's perspective as well, it gives them another avenue of fundraising to support their infrastructure projects.
Well, when we started this interview, you mentioned a couple of points that you liked about the budget. So keeping that in mind, what sectors are you overweight as well as underweight on post-budget announcements? As
a fund house, Chun, we are not. We consider ourselves bottom-up stock pickers. Therefore, we do not generally overweight or underweight sectors. However, as I mentioned at the outset, the budget is pretty much neutral for the market. But if I were to come up with a few sectors that would benefit from an equity fund manager's perspective, then, as I mentioned before, I think the property sector would benefit because expectations were pretty low. Expectations was for RPGD to be raised more significantly. Given the emphasis, again, on Tun Razak Exchange, on the ETP projects, incentives to stimulate refineries, I think the oil and gas sector would benefit. Building materials, of course, would benefit. And finally, on tourism, I already mentioned in passing, if the incentives to stimulate tourism works, then retailers, the malls, airlines, airport operators would benefit. Apart from that, the other sector that we've liked, and this is independently of the budget, is really the plantation sector, where we think demand from emerging markets would continue to grow, and this is a structural trend.
Thanks very much. We've been speaking with David Ng of Huang Investment Management.